Hey guys, welcome back to the channel. I hope everyone is doing great. Today I want to do another video of sample portfolio using options high yield ETFs. Today I'm going to try to use QQQY, SVOL, or CYA and CLIP as a sample, just as a kind of follow-up to a previous video that I made regarding a sample portfolio for QQQY, TLTW, and CLIP, and just kind of see what the difference are. So I think Defiance Yieldmax ETFs are great, but I feel like we're maybe not properly allocated, and maybe there's like some risk that we can maybe chop off. And I wanted to see if SVOL and CYA are any good. I looked at some simplified ETFs before, for example, Maxi. I wasn't too happy with that, but that's only because of they're using futures instead of an actual Bitcoin spot ETF. Maybe in the future they'll come up with a product once someone comes up with a Bitcoin spot ETF or that's approved by the SEC. So I was wondering if there was any new yield opportunities. So Yieldmax, Defiance, and Simplify, they seem to be kind of three of the bigger players in this space. So let's just see what something with CLIP, CYA, or Triple QY, or CLIP CYA, or sorry, CLIP as well in Triple QY would look like. So I've showed this before, like the cheat sheet for Triple QY, and I think for myself, I would like to make this one of the pillars of my high yield options portfolio. So far, it's only made one dividend payment, so that's the only information that we have, at least for now. And if we took a look at cheat for CYA, I'm not happy with the expense ratio, but one of the good things that they're doing is because CYA is based off of other simplified ETFs, they're willing to cut us a break by lowering it a little bit by doing a temporary fee rebate, which I think is pretty good for um, just to be more shareholder friendly. The distribution yield is a little bit low, but I mean, given the type of product that it is, I think it could be okay for now. Because like the expense ratio is a little bit high, so it's gonna drag down the returns a bit. And CYA, it's supposed to be sort of like a tail risk type of product. And if you look at the some of the older holdings, like they're using other simplified ETFs, so there's an enhanced income, there's an interest rate hedge, and then it's also using treasury futures as well. And it looks like they're also using uh, call bull spreads for certain products, and then also maybe like a mix of put spreads to hedge like downside exposure. So I think this is a pretty interesting product. SVOL. So this has been pretty popular, and there's something in here that I'm not too comfortable with just yet, but I'll show you in a upcoming slide. The expense ratio for this type of product isn't too bad considering how complex it is. So they're using a combination of VIX futures and then VIX uh, index options, and it looks like they're using spreads to kind of cap off any upside risk. Or I guess in this case is downside risk, but it'll make more sense once I kind of show you like some of the holdings. So the distribution yield isn't too bad, and I wanted to also show you that within this ETF, it's kind of funky because like they have bond ETFs in here, and as I mentioned before, they have VIX futures. So it looks like they're selling the futures but buying the calls just in case. Because I think the what they're trying to do is they're trying to capture the kind of like a spread between the current VIX and the future VIX, and this will work well if VIX stays within a certain range. And so far, like it's been out for a while, but I think there's a weak point that makes me a little bit uncomfortable. And then the final piece of the this portfolio is CLIP. So this is a Chinese internet-based ETF, or I guess like the way to phrase it is it's based off of a ETF called KWeb, and they have holdings of Chinese internet companies. So and sometimes like I guess like if you can buy it at a small discount, like as you can see in this screenshot, keep an eye on like for day to day. Maybe you might get lucky and you might buy um, kind of like a discount to whatever the assets are worth. And they've been pretty good in terms of paying out their dividends. Oh, and I also almost forgot to mention for CIA, uh, they have an end of month distribution, but they actually missed two dividend payments. So that's one area of concern that I have. So, and if you want to do part of this yourself, you can always, if you have a relatively large portfolio, there's the options on triple QY are starting to get more liquid, but it's still new, so that the spreads aren't as good as normal stocks or ETFs. So, for example, if you look at the 18 strike over here, it's a bid of zero and an ask of 90, and I mean, if you get filled on the mid price, like 45 cents, so on 100 shares, that's $45, which isn't too bad considering it's new. But I would like to see this kind of like the spreads improve as time goes on. And this is probably the most important slide for to see the correlation for CYA and SVOL with triple QY. So the CYA product, I like this because it's actually negatively correlated. So that means if triple QY takes a dive, the returns of CYA should offset part of it. And I was a little surprised, but I guess I shouldn't be for SVOL, since it's a short volatile fund. It has a pretty high correlation with triple QY at almost 90%. So this SVOL isn't as desirable as I thought. Um, I wouldn't mind holding it if I can get it maybe at a discount to NAV. But I guess like for right now, I would personally hold off on SVOL and see if there's any opportunities for CYA to improve in the future. So I ran I used a average scenario of all the dividend payments that it's made so far. And again, like I'm not too comfortable with the August and September payment being missing, and I couldn't find any information online as to why. So I'm gonna also kind of hold off on the CYA for now, or maybe like in the future, maybe there's a replacement product that might be better. So if you remember from my last video, I did a portfolio of triple QY, TLTW, and CLIP, and the results for like for the average scenario was 4.46. So with the triple QY, CYA, and CLIP, you can see the returns dips a little bit, but which isn't too bad. So so CYA is something I'm keeping an eye on to see if maybe in October like the payment might return, because there has been like volatility in the market, so maybe some of these hedges started to pay off. And then also did the same thing for the average scenario of like the interest payments that were available since as follows available since September 21. So that's a pretty decent track record. Excuse me. So it has um, if you use a triple QY as vol and clip, you'll get roughly a 4% monthly return. Again, which is lower than the original triple QY, TLTW, and clip. So for now, I think like just in terms of overall safety of the dividend payment and then of the structure, I would probably prefer to have triple QY, TLTW, and CLIP as my maybe as a kind of like my my backbone or pillar of like my high yield dividend portfolio. So I think in like the pros of this approach in that since you're using ETFs, it's pretty easy to put together a portfolio that has a low correlation within each of the individual ETFs. And it might save on fees for small accounts. And these companies are fairly transparent. They'll show you the holdings. And there's a chance to offer you better diversification without buying a whole bunch of different products, like for example, different stocks, different futures, different options. It's done for you in a professional way. Uh, but of course, like you're paying for the professional management. So uh, the expense ratios are highest at 65 to 75 basis points, but it's a little bit lower than like say for example Yieldmax and Defiance. Um, Again, I want to highlight that CYA the monthly dividend um, we're missing for 2 months. The SVOL the short since the strategy is generally short volatility. This could really blow up during like if there's another flash crash or like a pandemic or some war or something horrible in bad times. Like this is would not be a great strategy because you're basically like like you're double exposed. First, like if your normal stock portfolio goes down, since you're shorting volatility, you this product will also go down. So that's kind of negates the purpose. So you're not really getting any volatility. Now, maybe in the future, if there's a long volatility fund, that could be interesting. And I think that's what CYA attempted to do. But well, we'll see. I want to keep an open mind. I think it's good that there's multiple competing products. So, and then of course you don't have any control over your option strike selection, and implied volatility could collapse in certain sectors, and that could really hurt your returns overall. Some of these products aren't available at all brokerages, so it's good to have maybe multiple brokerages to maybe spread some of your assets around too. So, and of course, yields are not consistent month to month. And if you want to put together a portfolio, sometimes it does involve a little bit more work. You have to do a little bit research and see like how they move against each other. But I think overall, like, these products are good and they're professionally managed. If you like this type of content, please consider giving this video a like and subscribe, please. That would really help me out. And I will look forward to making more videos for you in the future. Thank you and have a great one.